What if I told you that silver just did something it hasn't done in over a decade, and one of the biggest banks on Wall Street is warning that this party might be coming to an end? What if I told you that some investors have made 150% returns in just 1 year, while others are about to get burned? Hey everyone, welcome back to the channel. Today we're diving deep into one of the most dramatic and controversial stories in the precious metals market right now, a story about silver's absolutely insane rally, a critical ratio that veteran traders watch religiously, and why BMO Capital Markets just threw cold water on what many are calling the greatest silver bull run in modern history. If you're invested in precious metals thinking about it, or just fascinated by market dynamics and how fortunes are made and lost, you absolutely need to hear this. This isn't just about silver and gold. This is about understanding market cycles, recognizing when speculation might be getting out of hand, and knowing when the smart money is starting to head for the exits. Let me paint you a picture of what's been happening in the silver market, because honestly, calling it wild doesn't even begin to capture the magnitude of what we're witnessing. Right now, as I'm recording this, silver is trading above $91 an ounce. Now, if you've been following the precious metals market for any length of time, you know that's extraordinary. But here's where it gets really interesting. Silver recently touched $93 an ounce, setting new all-time record highs that have traders, investors, and financial analysts absolutely buzzing with excitement and, in some cases, genuine concern. But the real story isn't just about the price tag. It's about the move. It's about the velocity, the momentum, the sheer force of this rally. Last year, 2025, silver rallied nearly 150%. Let me repeat that because it bears repeating. 150% gains in a single year. That's not a rally, folks. That's a moonshot. That's the kind of performance that makes cryptocurrency traders jealous. That's the kind of return that venture capitalists dream about. And it happened in a traditional commodity market that's supposed to be relatively stable and predictable. To put that in perspective, if you had invested $10,000 in silver at the beginning of 2025, you'd be sitting on $25,000 by year's end. That's life-changing money for many people. That's the difference between a nice vacation and a down payment on a house. And here's the kicker. The momentum hasn't stopped. Here we are in early 2026, barely 2 weeks into the new year, and silver is already up more than 27% year to date. We're talking about gains in days and weeks that most investments take years to achieve. Meanwhile, gold, the traditional safe haven, the granddaddy of precious metals, the asset that central banks hoard and investors flee to during times of crisis, is only up about 6%, holding support above $4,600 an ounce. Now don't get me wrong, 6% is absolutely solid performance, especially in the early days of a year. Most investors would be thrilled with 6% annual returns. But compared to silver's meteoric rise, it's not even in the same galaxy. It's like comparing a commercial airliner to a rocket ship. This performance gap is what's creating all the buzz, all the speculation, and all the warning signs that we're going to discuss today. So what's driving this absolutely unprecedented rally in silver? Why is this happening now? And why is silver leaving gold in the dust? Well, it's not just one thing. It's a perfect storm of factors that have converged to create what might be one of the most powerful bull markets we've seen in any commodity in recent memory. Factor number 1, speculative demand. Gone wild. First, you've got renewed and intensified speculative demand. Traders are piling into silver like it's going out of style. We're talking about serious momentum trading here, the kind where everyone wants in because the price keeps going up, which makes the price go up more, which brings in more traders, which pushes the price higher still. It's a self-reinforcing cycle, a feedback loop that can create absolutely explosive moves in both directions. This kind of trading has been amplified by social media, online trading forums, and the democratization of investing through apps and platforms that make it easier than ever for retail investors to jump into commodity markets. When silver starts trending on social media, when YouTube videos about silver gains start going viral, when your uncle at Thanksgiving dinner starts asking you about buying silver, that's when you know speculative fever has really taken hold. Factor number 2, real industrial demand. But here's what makes this different from pure speculation. Silver also has something that gold doesn't have to the same degree: robust, undeniable industrial demand. Silver isn't just a shiny metal that looks pretty or serves as a store of value. It's a critical industrial metal with unique properties that make it irreplaceable in many applications. Silver is the best conductor of electricity among all metals. It's used in everything from smartphones to computers, from electric vehicles to medical equipment, from solar panels to water purification systems. Every time you turn on your phone, there's silver in there, making it work. Every time someone gets an X-ray, silver plays a role in the imaging process. This industrial demand creates a floor under prices that pure speculative assets don't have. Even if investor interest wanes, industries still need silver to function. And that matters. Factor 3. The supply crunch. And here's where things get really interesting and really tense. This combination of speculative buying and industrial demand has created what the professionals call supply chain and liquidity issues. In plain English, there's not enough readily available silver to satisfy all the people and companies who want it right now. Think about that for a moment. We're talking about a physical commodity with actual supply constraints. This isn't like a stock where a company can just issue more shares. You can't print silver. You can't create it out of thin air. It has to be mined, refined, processed, and delivered, and that takes time, capital, and resources. Factor 4. The mother of all short squeezes. This supply-demand imbalance has triggered what's known as a multi-month short squeeze, and if you understand what that means, you understand why prices have gone parabolic. For those unfamiliar with the concept, let me break it down. A short squeeze happens when traders who bet against silver, who shorted it, expecting prices to fall so they could profit from the decline, suddenly find themselves on the wrong side of the trade as prices rise. As losses mount, they're forced to buy silver to cover their positions and limit their losses. But that buying pressure pushes prices even higher, which forces more short sellers to panic and cover, creating even more buying pressure. It's a vicious cycle if you're on the wrong side, and it can lead to absolutely explosive price movements. We saw this with GameStop. We saw it with AMC, and now we're seeing it in silver, except this time it's in a market that's much, much larger and has real industrial fundamentals backing it up. The result? Silver has earned a new nickname in some circles, a meme investment. It's drawing comparisons to those legendary Reddit-fueled short squeezes that made headlines and changed the investing landscape forever. Now here's where we need to talk about something that serious precious metals investors, hedge fund managers, and professional traders watch very carefully, sometimes obsessively: the gold to silver ratio. If you're new to this concept, don't worry, I'm going to explain it in detail because understanding this ratio is absolutely critical to understanding why BMO is sounding the alarm. What is the gold to silver ratio? This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. It's calculated simply by dividing the price of gold by the price of silver. So if gold is trading at $4,600 and silver is at $92, the ratio is 50. That means you need 50 ounces of silver to equal the value of 1 ounce of gold. Simple enough, right? But why does this matter so much? Why this ratio is so important? This ratio is a critical metric that reveals the relative value between these two precious metals. It tells us whether silver is cheap relative to gold or expensive relative to gold. It helps professional traders identify opportunities and risks, and it has a historical tendency to revert to certain levels over time. Think of it like a rubber band. You can stretch it in one direction or the other, but eventually it wants to snap back. The gold to silver ratio works similarly. When it gets stretched too far in one direction, market forces tend to push it back. The current situation is extreme. Right now, that ratio has crashed to 50 points. That means it takes about 50 ounces of silver to equal the value of 1 ounce of gold. And here's why that's such a big deal. This is the lowest level we've seen since March 2012, over 13 years ago. We're in territory that an entire generation of younger traders has never experienced, and the swing has been absolutely dramatic. Just last April in 2025, this ratio was above 100 points. Think about that for a second. In less than a year, the ratio has been cut in half. That's an absolutely massive, unprecedented shift that tells us silver has been dramatically, explosively outperforming gold. Historical context matters. Now let me give you some historical context because this is important. Over the last century, this ratio has averaged somewhere between 60 and 80. There have been extreme periods where it's gone as high as 120 during times of crisis when people flee to gold, and as low as 30 or 40 during silver bull markets. But here's the key insight that professional traders understand. This ratio tends to revert to a mean over time. When it gets too high, say above 80 or 90, silver becomes relatively cheap compared to gold, and smart money starts flowing into silver, bringing the ratio down. When it gets too low, say below 50, silver becomes relatively expensive compared to gold, and the ratio tends to climb back up as gold outperforms. We're currently at that low extreme, and that's exactly what BMO Capital Markets is warning about. In a research note published this week, BMO's commodity analysts dropped what can only be described as a reality check, some might even call it a bucket of cold water, on the silver market. And their message is clear, unambiguous, and frankly, a little bit ominous. This might not be sustainable. The short-term acknowledgement. Now, to their credit, BMO isn't being blindly bearish or dismissive of what's happening. They acknowledge that the ratio could fall even further in the very short term. The momentum is real. Geopolitical uncertainty is real and creating genuine demand for precious metals. The meme investment phenomenon is real and powerful. Speculative momentum, once it gets going, can carry markets further than anyone expects. We've all heard the famous quote attributed to economist John Maynard Keynes, "The market can stay irrational longer than you can stay solvent." BMO understands this. They're not saying the rally will end tomorrow or next week. The big but, and this is a massive, consequential but, they're forecasting something that could fundamentally change the entire equation, a growing surplus of physical silver. This is the core of their bearish thesis, and if they're right, it changes everything. The historical relationship. Here's their key insight, based on decades of data analysis. Since the end of the Bretton Woods system back in the 1970s, when the world moved away from the gold standard, there's been a strong, reliable, almost mechanical relationship between physical silver surplus and the gold-to-silver ratio. The pattern is clear. When there's a large surplus of silver flooding the market, the ratio increases. Silver gets cheaper relative to gold. When there's a deficit, when demand exceeds supply, the ratio falls. Silver gets more expensive relative to gold. And BMO's analysts, after crunching the numbers, looking at supply forecasts, analyzing demand trends, and building out their models, are predicting we're heading into surplus territory. And not just a small surplus, a growing one that will persist for years. The misleading numbers. Now, here's where BMO's analysis gets really technical and really interesting, so stay with me because this is the meat of their argument. Most analysts and commentators, when they look at the silver market right now, see what appears to be a deficit. The numbers show demand exceeding supply, and on the surface, that seems bullish for prices, right? If there's not enough silver to meet demand, prices should go up. But BMO argues, and this is crucial, that this deficit calculation is misleading. It's based on flawed methodology that doesn't capture the true dynamics of the market. The real story: consumption versus investment. Why is it misleading? Because the vast majority of silver stocks, the silver that's been mined and refined and is sitting in vaults and warehouses and investment holdings around the world, is held by investors, not consumed by industry. A true deficit would mean that investors are actually selling their physical silver holdings in large quantities to meet industrial demand. But that's not really happening at any significant scale. What we're seeing is investors buying more silver, not selling it. BMO argues that we need to look at a different, more accurate metric: consumption versus supply. And by consumption, they mean the silver that's actually being used up, destroyed, incorporated into products that won't return that silver to the market anytime soon. We're talking about industrial applications, jewelry, silverware, the silver that gets consumed, not the silver that gets stored as an investment. When you look at the market through this lens, BMO sees something very different. They see supply exceeding consumption, and that, by definition, creates a surplus. What this means for prices. If BMO is right about this growing surplus, the implications are significant. Surpluses create downward pressure on prices. They give buyers leverage. They reduce the urgency to purchase. They allow the market to breathe and for speculative excess to unwind. And that brings us to BMO's ultimate conclusion. They believe silver will underperform gold going forward. Not necessarily crash, not necessarily collapse, but underperform. The gold to silver ratio will rise. Gold will be the better investment over the coming years. Here's a critical piece of the puzzle that most casual observers aren't talking about, but that BMO has identified as a major factor in their bearish thesis. Solar power demand for silver is peaking. Why solar matters so much? Let me give you some context on why this matters. Solar panels use silver, a lot of it. Silver is a critical component in photovoltaic cells because of its superior electrical conductivity. Every solar panel that gets installed requires silver, and solar has been absolutely booming. The renewable energy revolution, government subsidies, corporate sustainability commitments, and falling installation costs have driven explosive growth in solar installations worldwide over the past several years. How important has solar been to silver demand? BMO's research shows that solar has represented 58% of the increase in silver consumption since 2020. Read that again, 58%. More than half of all the growth in industrial silver demand over the past 5 years has come from one sector. That's massive concentration. And when one sector represents that much of your demand growth, what happens in that sector becomes existentially important to the entire market. The storm clouds gathering, but BMO sees storm clouds on the horizon for solar-driven silver demand, and they identify two major problems. First, solar installations are plateauing. The explosive exponential growth we've seen in recent years is slowing down. We're still adding capacity, but the rate of growth is declining. Markets are maturing. The easiest, most economically attractive installations have already been completed. Subsidy programs in some regions are being scaled back or becoming more competitive. Second, and this is perhaps even more important in the long term, there's what BMO calls persistent silver thrifting in solar technology. Engineers and materials scientists are constantly working to improve the efficiency of solar panels, and one major way they do that is by reducing the amount of expensive materials required. Material science is working against silver. They're getting better at using less silver per panel while maintaining or even improving performance. They're developing alternative materials. They're optimizing the microgrid patterns that use silver. It's called material efficiency, or thrifting, and it's happening across the industry as companies compete to reduce costs and improve margins. Think of it like fuel efficiency in cars. Every year, cars get better mileage, using less gas to go the same distance. The same principle applies here. Every new generation of solar panel uses less silver to generate the same amount of electricity. The conclusion is sobering. When you combine plateauing installation growth with improving material efficiency, BMO reaches a sobering conclusion. Silver demand from solar is likely past its peak. We may have already seen the highest level of silver consumption from the solar sector that we're ever going to see. That's a big deal when solar has been such a dominant driver of industrial demand growth. If that engine is sputtering, what replaces it? Now, before you think it's all doom and gloom for silver, that BMO is predicting an apocalyptic collapse. Hold on. There's a potential game changer on the horizon, a wild card that could completely rewrite the demand equation: solid-state batteries. The promise of solid-state technology. For years, actually for more than a decade, solid-state batteries have been the next big thing in energy storage. They've been promised to revolutionize electric vehicles, to solve range anxiety, to enable faster charging, to improve safety, and to increase energy density beyond what current lithium-ion batteries can achieve. But they've also been perpetually 5 years away from commercialization. It's become something of a running joke in the battery industry. Every year we hear that solid state is almost here, and every year it remains stubbornly in the laboratory or in small-scale pilot production. Finally, real progress. But here's what's different now. There are finally genuine, credible signs that solid-state batteries might actually be on the cusp of commercialization, and silver carbon anode technology is a key enabler for making these batteries work at scale. Major companies with deep pockets and serious engineering expertise are making significant investments. We're talking about giants like BYD, the Chinese electric vehicle manufacturer that's now one of the largest EV makers in the world. We're talking about Samsung and LG Energy Solution, two of the most sophisticated battery manufacturers on the planet. These aren't startups making wild promises. These are established companies with reputations to protect and billions of dollars to invest in making this technology real. The potential is enormous. BMO has done the math, and the potential demand is enormous. They estimate that if solid-state batteries successfully transition from the lab to commercial production at scale, this could contribute up to 100 million ounces of silver demand by 2030. To put that in perspective, total global silver mine production is around 800 to 900 million ounces per year, so solid-state batteries could add more than 10% to total demand. That's not a trivial amount, that's a market-moving quantity, the massive if. But here's the thing, and this is crucial. Could and if are doing a tremendous amount of heavy lifting in that forecast. Could contribute up to 100 million ounces is very different from will contribute 100 million ounces. If commercialization efforts are successful is a massive assumption. Until solid-state batteries become commercially viable at scale, until they're being mass-produced and installed in millions of vehicles, until the technology proves itself in the real world and not just in press releases and pilot programs, they remain just a possibility, not a reality. They're a hope, not a certainty. They're a potential future, not a present fact. BMO's stance. And BMO, in their analysis, is essentially saying, we're not going to bet the farm on an unproven technology. We'll acknowledge the potential, we'll include it in our risk scenarios, but our base case forecast doesn't assume solid-state batteries will save the silver market. So where does all this leave us? What's the actual practical takeaway from BMO's analysis? And what should investors do with this information? BMO's core forecast. BMO's bottom line is clear and unambiguous. Even when they build in favorable assumptions, even when they assume strong continued demand from the electric vehicle space, even when they assume minimal efficiency improvements in industrial silver usage, even when they give silver every benefit of the doubt, they still expect the physical surplus to grow over their forecast period. Let me translate that into plain English. They believe that more silver will be produced than will be consumed in industrial applications. Supply will exceed real demand, and that imbalance will put downward pressure on prices relative to gold. The performance prediction. Their prediction? Silver will underperform gold going forward. Not crash, not collapse, not go to zero, but underperform. Deliver lower returns. Be the less attractive investment in the precious metals space. The short-term caveat. Now, they're careful to acknowledge, and this is important for traders and short-term investors, that the ongoing exuberance in the silver sector could push the gold-to-silver ratio even lower in the coming weeks or even months. Momentum is a powerful force. Speculative fever can carry markets far beyond what fundamentals would suggest is reasonable. FOMO, fear of missing out, can drive prices to levels that make no sense when you look at supply and demand. We might see silver hit $100. We might see it hit $110. We might see the gold-to-silver ratio drop to 45 or even 40. In the short term, anything is possible in a market gripped by speculative mania. The long-term view. But, and this is BMO's key message, they expect the long-term trajectory of the ratio to be firmly upward. Over the next several years, they expect gold to outperform silver. They expect the ratio to climb back toward more normal historical levels, perhaps into the 60s, 70s, or even 80s. For investors, that means gold becomes the better long-term hold in the precious metals space, while silver carries increasing risk of disappointment and underperformance. The critical question, is BMO right? Now, here's the million-dollar question. Or in this case, the multi-billion-dollar question that will determine whether fortunes are made or lost. Is BMO right? That's what everyone wants to know? That's what's going to be debated in trading rooms, on financial television, in online forums, and at dinner tables where people talk about their investments. And the honest answer? We don't know yet. Nobody knows for certain. Scenario 1. BMO is correct. BMO could be absolutely, perfectly correct in their analysis. Their data could be sound, their modeling could be accurate, their assumptions could prove prescient. In that scenario, silver investors, particularly those who got in late, who bought at $80 or $90 an ounce, who believed the hype that silver was going to $150 or $200, could be in for a painful reality check as supply catches up with demand, speculative fervor cools off, and prices drift lower or stagnate while gold continues to perform well. Scenario 2. BMO is wrong, or BMO could be underestimating several critical factors. They could be wrong about the surplus. They could be underestimating the power of sustained speculative and investment demand. They could be too pessimistic about solid-state batteries and other emerging technologies. They could be missing something in their analysis that will become obvious only in hindsight. Markets have a funny way of proving even the smartest analysts wrong. There have been countless examples throughout history of banks and institutions making confident predictions that turned out to be spectacularly incorrect. The wildcards. There are also wildcards that BMO might not be fully accounting for. Geopolitical tensions could escalate, driving safe haven demand for all precious metals. Currency crises could emerge, making hard assets more attractive. Mining supply could disappoint due to operational issues, labor strikes, or regulatory challenges. New industrial applications for silver could emerge that nobody is currently forecasting. The future, as they say, is uncertain. What I can tell you with certainty. What I can tell you with certainty is this: when one of the major international banks, with teams of PhD economists and commodity analysts, is publishing detailed research notes warning about a market that's up 150% in a year and still climbing, it's worth paying very close attention, whether you ultimately agree with their analysis or not. It's worth understanding their argument. It's worth stress testing your own thesis. It's worth asking yourself hard questions about whether you're investing based on fundamentals or just riding momentum and hoping to get out before the music stops. Before we wrap up, I want to give you some additional historical context because understanding the past can help us navigate the present and anticipate the future. The 2011 silver peak. The last time we saw silver fever like this was back in 2011. Silver rallied from around $18 an ounce in late 2010 to nearly $50 an ounce in April 2011. That's a nearly 180% gain in just a few months. It was explosive. It was exciting. People were convinced silver was going to $100, to $150, that it was going to the moon. The gold-to-silver ratio collapsed to the low 30s during that peak. Silver was dramatically outperforming gold. Everyone wanted in. The fear of missing out was palpable. And then reality set in. By late 2011, silver had crashed back to the mid-20s. By 2015, it was trading in the teens. People who bought at $45 or $48, thinking they were getting in before the really big move, saw their investments cut in half, then cut in half again. The gold-to-silver ratio? It climbed back to the 60s, then the 70s, then during the COVID pandemic in 2020, it briefly touched 120. The pattern. The pattern is clear. Silver tends to overshoot in both directions. It gets too expensive relative to gold during bull markets, driven by speculation and momentum. Then it gets too cheap during bear markets and periods of risk aversion when investors flee to gold's safety. What 2012 tells us March 2012, the last time the gold-to-silver ratio was as low as it is today, was near the end of silver's bull run. It wasn't at the absolute top, but it was in the late stages. Within months, silver began a multi-year decline that devastated late buyers. Does that mean history will repeat exactly? Of course not. Every market cycle is different. The circumstances today are not identical to 2011 or 2012, but patterns rhyme. But as Mark Twain supposedly said, history doesn't repeat, but it often rhymes. And right now, there are definitely some rhymes that should make silver investors at least a little bit nervous.